All right, welcome back to the weekly rebalance. We've skipped a couple weeks here. Nick had a big day last Saturday, and we're ready to dive into that big day. I want to hear a little bit more about it, and then cover some markets and some big changes at the Fed. So I'm ready to get going if you are, Nick.
Yeah, I'm ready to go. Let's do it.
So what was the big day?
Oh, well, I sat for level 3 on Saturday. And yeah, unfortunately, I had to take it on a Saturday because they didn't have any options during the week. So me and a
Yeah,
bunch of other vested fellows were sitting there taking our tests. Although I
nice.
wasn't wearing a vest. There was a guy wearing a vest, though. I thought it was really funny. I was behind him in line, and I asked him if he was sitting for level 3, which of course he was. So
Yes.
that guy's dedicated. He's really dedicated to the outfit.
He
I am
didn't
not.
even change on the weekend.
Not even for the weekend, not even for a test. I was in a hoodie, so
Yep.
points for professionalism on that guy.
That's awesome. I assume it was Patagonia.
No, but it was a nicer one. You could tell. I can't remember what it was. It was not a Patagonia vest though.
Oh, too bad. Too bad.
I don't think you have a Patagonia vest.
I
Do you?
don't, but I should get one. No,
Yeah,
I
you
don't.
should.
I don't. I got a bunch of Columbia ones, some Vineyard Vines,
Oh my
your
gosh.
typical finance stuff.
Yeah, I don't own any vests, and I think we're gonna keep it that
Yeah, absolutely.
way.
That's funny. Well, boy, it's been a wild little week here. I'm looking at the markets sitting here right now. It's just closed a little bit ago. Amazon's down to 7%. The market's down more than 1% today. The S&P 500. It's been a wild couple of weeks here since we last got together.
It really has been a lot of news to digest and growth. We've kind of seen it sell off as opposed to being a little bit more stagnant like we saw earlier in the year, which I found that interesting.
Yeah, absolutely. And very, very different. Like, let's see, the S&P 500 year to date is now down almost 1%. Don't quote me on these exact numbers, but almost 1%. The S&P 400 up 3.9%. So
Yeah,
for mid cap, up, mid cap's up, small cap as measured by the six S&P 600 up almost 6%. Very different year, especially one of my favorites, the Dividend Aristocrat, up almost, well, 7.5% for the year. Very
yeah,
different year than we've had the last couple of years.
yeah. I was just gonna say I was pulling that up. Great performance from dividend aristocrats this year to date. I'm actually
Yeah,
seeing with total return level, so including dividends, up 8.58% year to date, whereas the S&P is up 0.63%. I'm using
yeah,
NOBL and SPY
gotcha.
here as my proxies, but that
Including
is
dividends.
including dividends. That's a total return metric, but that's really something and definitely not what we saw last year.
No, not at all. And something we did see, and not what we've seen the last 3 years. Something that did continue, that has continued thus far this year, though, which is different last year compared to the year before and the year before that as well. But emerging markets and developed markets continue to outperform the U.S. markets.
Yep.
Yeah, emerging markets, I'm seeing up 2.25. That's without dividends, but up 2.25. Let's see, where's my developed markets proxy? Developed markets is also up as well, 4.425. So very different than what's led the way the last 3 years. I think it's likely to continue.
Yeah, I mean, we've been kind of talking about this for about a year now, how these growth names have gotten more and more extended, how we can't expect to see multiple expansion continue to just drive returns for these companies for forever. And
Right.
either they're going to have to pull back into reality and come back to a more historical average, or those earnings are going to have to catch up with the relative values that we're at right now. And so we've seen a bit of both of that. We've seen some stagnation at the beginning of the year, and we've seen prices pull back to get more in line with historical values. Some names are even looking cheap. I think we were talking about that earlier, especially compared to
Hmm.
how they've looked historically. Historically, being the past 3 years, some of these growth names are coming back to reasonable valuations, making them attractive.
Yeah, absolutely. Which makes sense. Valuation multiples don't extend and continue to compound forever. It just can't happen. The beginning of the year, the S&P was at 22 times forward earnings. If you look at that versus its 30-year average, the 30-year average is 17 times earnings. So much, much has to change. Something has to change. Either that has to come in or earnings have to grow significantly, or a little bit of both, right? And I don't think we're seeing an implosion at this point in those names, although, watching Amazon after market hours today might beg to differ. But it's normal to see some other names, some other styles lead the way after you've had, especially after the amount of time that we've seen multiples expand, since 2022.
Definitely. Yeah. It'd be very difficult for that to continue forever. There's been a lot of talk about how this excitement around AI is driving that multiple expansion, and we're expecting to see higher growth rates, which will bring those valuations in line more quickly. But we're kind of getting to that point now where we're realizing maybe there's a little bit longer road ahead than initially expected. We're getting a lot of productivity gains already, but maybe not quite as quick as some people were saying, or as quick as the market might have hoped for based on how quickly valuations grew. So,
Right. Well, the other thing with the AI growth diffusion, I think we saw these hyperscalers outperform significantly the last number of years, and that's your top of the S&P, your Nvidias, your Microsofts, et cetera. But I think it can be misinterpreted when you say that, you're calling into question the valuations of these names. It can be taken in a way that says you're in disbelief of the AI boom. I don't think of it that way. Really, if you see a lasting growth in a particular space like that, you have to have it spread out to the rest of the market. So the way that I've looked at that, and the way that we've talked about this internally, this is, I believe, our joint view, but you see a trickle down into infrastructure beneficiaries, your data centers, your power assets, then productivity winners, which are already starting to see, but I think we'll see, exponential growth in productivity for companies that use it very well and improve their unit economics through the use of AI. And then you'll start to see this late cycle monetization. We're actually creating new products that we're not even aware of today, that we might not even be able to think up today because, we're so far away from it. But that's going to happen. That's, very bullish on AI. And, I think that has to happen unless it's a fad, right? Which I don't think it's going to be. But if it were a fad that was going to go away and all of a sudden the market moves on to something else and AI was not what it's cracked up to be, then, you would see these hyperscalers go up and then fall, right? And it not spread out to the rest of the market. But if you're truly bullish on AI, in my opinion, and the use of AI, you have to see it trickle down to the rest of the market. And the rest of the 493 names in the S&P, the mid cap names, small cap names, et cetera, they're going to start to benefit from that through one, if they're infrastructure companies, data centers, power assets, they're going to benefit. And then there's going to be a lot of productivity gains in the rest of those names where they're actually able to improve their unit economics because of the use of AI. That should be us. That should be, in my opinion, part of the next couple of phases if we really want to be truly bullish on AI for the next decade.
yeah. And I don't think that the market's selling off necessarily the AI story. I mean, take a look at SanDisk and you can prove the opposite of that. Up, what is it, 100 yeah, I'm taking a look here, 110% almost year to date, even with them pulling back a little bit today.
Yeah,
So, we're moving on from, at first it was GPUs, and GPUs are really the thing that's creating the growth with NVIDIA. And now we're realizing, oh, we need a lot more memory. And it's moving into other segments that we're realizing we need more and more of. And then, like you said, we're realizing productivity gains in other segments.
right.
Infrastructure companies that are needed to expand are also doing very well. So definitely not selling off the whole AI trade entirely. It's just there's been some names that have gotten a lot of the love recently. They've gotten most of the attention around the AI trade, and coming to realize that there's some other more hidden companies, I guess, if you want to call it that, that benefit from this as well in a meaningful way. So
Right. Totally agree. Well, we'll have to keep following it. It's certainly been an interesting ride. I think a lot of people a little bit surprised by it, but if you look at it, a lot of it makes sense.
Definitely.
So, anyways, the other big news, moving on to our research of the week, is we've got a new Fed chair, or at least a proposed new Fed chair, not actually in place until May if he's approved, but the markets reacted to that a bit as well, didn't they?
Yeah, they certainly did. They certainly did.
Yeah,
I found that one to be interesting, especially because when Kevin Warsh was announced, we've been talking about this on the podcast as well. We were leaning towards expecting a Hassett as opposed to Warsh. Warsh was one of the names that was out there, but he certainly wasn't at the top of anyone's list up until
right.
very recently. So I think that was a surprise. And then, I think also just his position in general, kind of a little bit contrary to what I might have expected from someone that Trump would appoint to that position. Not necessarily that he's opposing him on policy rates, because
Right.
he does want to bring those down, but more of on the Fed's balance sheet.
Yeah, yeah, absolutely. And I think that the market reacted to that. The market
Oh yeah,
reacted to the potential. He's a more hawkish choice than everyone thought Trump was going to choose, which, but like you said, it was definitely it made a big impact, and markets reacted accordingly. I mean, gold was down 9%,
yeah,
which makes sense, right?
yep,
In that scenario, if you're thinking that he's a bit more hawkish, that he's a bit more of an inflation hawk, that he is going to be, trying to restrict the balance sheet in a different way. I mean, that makes sense. Gold sold off, that not needed as much of a hedge, right? Silver even more, 27%, I think. Silver fell on Friday, which, if I'm not mistaken, was the biggest single day decline in history.
yeah. It
And
was certainly
crypto
up.
and Bitcoin too.
Yeah, it was certainly up there for sure. Yeah, it
Yeah.
was a really interesting pick, and just reading more and more about him, I think I mean, further just proves the case that he's an interesting pick. Um, yeah, mainly, I mean, I don't know. I think the main story here, in addition to, we were expecting whoever Trump would pick would be for lowering short-term rates, which, even
Right.
though Warsh, when he was on the board of governors, um, or when he was on the open market committee, when he was on there, he was pretty hawkish, and he was
Yeah.
pulling for increasing rates. But in this case, for the past few years, he's been adamant that he thinks rates should come down on the short term. The bigger thing is he wants the Fed to basically get out of QE altogether, even though he was part of the team that brought QE into the Fed.
Right.
That was a different time back then, coming into the financial crisis, but it definitely just a really interesting thing, and going to play out really. I don't know. It's going to be. I keep on saying interesting, but it's just going to be a interesting watch to see how the market digests that, especially long-term bond yields in particular. I think are going to be a big place to watch. Just one of the common things that gets talked about when we're talking about the Fed lowering rates is mortgage rates, and then financing of the U.S. debt, which I was taking a look into it. Currently, the U.S. debt has an average maturity of around 71 months. So that's a good bit longer. And it got longer recently, or a little while ago, when rates at the longer end of the curve were historically low. So they were bringing out that maturity date so that they could take advantage of those lower rates for longer. And so as the government goes to refinance their debt, potentially that's a little bit more costly, especially if they want to keep that longer maturity, which I would imagine if they're lowering rates on the short term, then they'll probably bring that in a little bit. But also just the 30-year, keeping an eye on the 30-year as well, because housing affordability is a huge thing in politics right now. A lot of candidates are running on housing affordability in one capacity or another. And one of the things that really impacts that is the 30-year rate. And likely, if the Fed pulls out of QE and starts shrinking their balance sheet, it's quite likely that we see longer term yields increase in a meaningful way. as the Fed kind of steps out and lets the market run its course. Uh, we've been in an inverted yield curve scenario for so long, and I think in part perpetuated by the Fed continuing this QE process pretty much since the financial crisis. The balance sheet just continues to get bigger and bigger, with a little bit of a pullback here recently since COVID. But uh, as the markets get more control over that part of the yield curve and the Fed takes a step back, they've got a $9 trillion balance sheet right now. That's going to be a pretty meaningful player in the marketplace leaving. That's a pretty big buyer.
Yeah, absolutely. Yeah, going to be very interesting to watch. And I think, it's not abnormal for markets they digest the new Fed chair transitions. It's not abnormal to have volatility, whether it be in equity markets or bond markets. It's a very common thing to see this volatility, and I would expect it. So, not it should not be surprising if the first half of this year, even a lot of this year is just more volatile in most markets, which we're already seeing. The first month, January, the first couple days of February are already very volatile. But there's a lot of things going on this year, and the Fed chair being one of the big ones. And it's not abnormal to see the markets test and try to figure out what's going on. And that churning creates volatility.
Yep.
So
Yeah, definitely.
yeah. Yeah. So I was looking at the S&P 500, just looking at their drawdowns after the periods where a new Fed chair took the helm. And it's it's very common to have pretty significant drawdowns. The Since 1930, the S&P 500 has logged average drawdowns of 5%, 12%, and 16% over 1, 3, and 6 month periods after the new Fed chair took the helm. So, I mean, if you think about that, those are more than average drawdowns, and it makes sense. They're digesting the new Fed chair and don't quite know what to make of it. Versus if you've had a Fed chair in there like Powell for many, many years, you kind of know what to expect in his conferences, so those aren't as surprising. You know what to expect in policy, so not as surprising. And that market actor, which is a big one, is just is when it's stable, it brings out takes out volatility from the market. It reduces volatility. When that's in question and unknown, like we are at this point, it's normal to have additional volatility, and it can be pretty extreme.
Oh, yeah, certainly a lot to process.
Yeah, absolutely.
I think
Definitely a lot to process.
yeah, I think the other interesting thing to talk about here too, Fed independence was one of the big things that was being talked about with the new candidate that was going to be proposed. And in terms of him wanting to step away from QE and purchasing assets, that's a pretty good sign, at least in my opinion. That's a pretty good sign for Fed independence. Now you can argue what you will about him wanting to lower the policy rate and how maybe that's bowing to Trump's wishes. I would argue Trump's picking someone that's views align with his own, um, at
Most
least on
likely,
that front.
yes.
Yeah, at least on that front. But in terms of shrinking the balance sheet, I mean, that's been a huge discussion ever since QE was introduced. I mean, the Fed is buying government debt to support fiscal policy and running a deficit. So in a way, it's enabling the government to run these huge deficits. So by taking a step back from QE, I think that's a pretty good sign for Fed independence.
Yeah, I agree. And again, it goes to the point that this was a different choice.
Mhm.
It started to come together, not unsurprising, I guess, by the time it came around and that was announced. But, you know, at the end of the day, that was not where we were 2 or 3 months ago. So very different choice.
Definitely,
So,
definitely.
yeah. Interesting. Well, what else you got on the change at the Fed?
Don't have anything else too interesting. I think we hit all the high points. I think
Yeah.
mainly the bigger thing that I don't see being discussed as much would be the QE piece. A lot of the headline news is covering the the policy rate and him wanting to lower it and saying, "Oh, he's Trump's wishes," that sort of thing. But I don't think the QE piece is being as covered as much as I think it should. So that was the
Yeah,
bigger thing.
probably should be covered more. Absolutely.
Yeah. Well, let's see here. I do have trivia. I've only got one, but I do
Sounds
have
good.
trivia.
Let's go for it. I've got one too.
Okay. Okay. Cool. Do you want to go first?
I can go first. Yeah, absolutely.
Doesn't matter to me. You go
All
on
right.
ahead.
Which Fed chair had the worst 1 month max drawdown during their first month after being appointed?
Oh boy. Like S&P or just a broad market
Using
index.
using the S&P 500.
Um, Volcker.
Not Volcker. I'll give you I don't this is going back into some into history quite a ways, but
Okay.
I'll give you the hint. The person was appointed in 1930.
Okay. Well, that makes sense. I don't. I have no idea who. I have no idea who the Fed chair was.
Eugene Meyer.
Okay.
Yep. Fed chair from 1930 to 1933, right in the beginning of the Great Depression and through the Great Depression.
Wow.
So
How much was the drawdown?
it was just above 15%, actually about 17%. I don't have the exact rounded number in front of me right
Gotcha.
now, but it was a little bit more than 15% that month,
Wow.
which makes sense during if you given the timeline there
Yeah,
in right in the middle of 1930.
that lines up.
Yep.
Okay. Well, I like that. I've got a similar one. It's not
All
exactly
right.
the same. What is the highest level that the Fed funds rate has ever reached throughout history?
Okay. I am gonna say highest it's ever been 18%.
That's close. That's closer than I would have guessed. 20% in March of 1980.
Okay. Wow. Yeah, I knew it
Yeah.
was pretty high. Well, you can, if you go back and talk to like my parents who in the 80s were, bank doing, adults,
Yeah.
and they talk about going to the bank and getting a CD for 15%, which sounds wild today, but it's not it wasn't uncommon back in that day.
Yeah, that's crazy. That really must have been wild to lock in a. I guess you could call it a risk-free 15 to 20%. That's a
Yeah,
wild thing.
pretty crazy. Yeah. Nowadays that sounds nuts, but yeah, pretty
I mean, inflation was out of control, so real rate of return maybe not
yeah, real world.
quite as impressive, but still, that's really something.
Yeah, absolutely.
Yeah, I,
Absolutely.
I think.
Good
Oh
question
yeah,
though.
yeah. No, thanks. I liked yours as well. The other interesting thing that I was reading about because when I was doing research into the trivia, I was reading about how they used to announce or not announce the policy rate or the policy rate window. And basically they would have bands where it could be up to 5%, not
Oh, really?
25 basis points. And this all changed in 1990 when the markets were reacting to the Gulf War. And they didn't even
Okay.
hold press conferences, which I mean,
Hmm,
going further back in time, maybe that makes sense. But I think the first press conference was in 1990 as well. So
interesting.
throughout the 80s, they had these 5% policy rate windows as opposed to 25 basis points. And I don't even think they were explicitly announced. It was kind of the market feeling things out and getting a sentiment
Yeah.
for what was going on. So, uh, yeah, just an interesting piece of history because that's certainly not what it is today.
No, certainly not. Well, the Fed has changed over the years. It certainly has.
Yeah,
So interesting. Well, good stuff. Thanks, Nick. Appreciate it.
absolutely. Thank you.
All right. Well, I don't, if you don't have any other closing thoughts, I think we can wrap up for this week and we'll be back to our normal schedule next week.
Yeah, all right. Well, looking forward to it.
Yep. Thanks, Nick. Me
Thanks,
too.
everyone.
Thanks, everybody. Bye-bye.